So I would consider this to be a big issue politically, and that this would obviously be very favorable for precious metals. Okay. I mean, a year ago, if you had talked to me for the last 40 years, every year, I would have told you that I increase my gold position. I've never sold any gold, and I've always bought every month's gold, and now I have a very large position. But I'm a bit afraid of governments taking it away. I've seen so much horror in wars and in amidst tensions and unjust actions by governments. Maybe it will touch me one day as well.
In 2024, the Fed is expected to implement rate cuts ranging from 0.75% to 1%, ultimately bringing the Fed funds rate to 4.6%. The impact of these cuts on gold prices is twofold. On one hand, lower interest rates make non-interest-bearing assets like gold more attractive. On the other, it could signal concerns about economic health, prompting investors to seek the safety of precious metals. Marc Faber, author of the Gloom, Boom, and Doom report, expresses political concerns. Despite holding a substantial gold position, he fears government intervention. The choice of safe havens may also depend on the prevailing market conditions. For instance, during economic uncertainty, gold and US Treasuries may be more attractive as safe havens. However, Faber foresees increasing volatility in precious metals due to the inevitable decline in the purchasing power of the US dollar. The idea that gold is becoming the world's new reserve currency is not new, and many analysts have debated this topic for years. While gold has been used as a currency for centuries, it will unlikely replace the US dollar as the world's reserve currency anytime soon. However, gold's role as a reserve asset is growing, with several central banks increasing their gold reserves in recent years. Moreover, Faber discloses his major asset is gold, constituting around 25% of his holdings. He firmly declares no plans to sell it while viewing the current price as appropriate. UBS, a financial services company, predicts that 2024 will be fruitful for gold, forecasting a price increase of 10% over current market prices. He states that there are challenges for Asian currencies, cryptocurrencies, gold and silver due to the declining dollar. He also predicts rising commodity prices in geopolitical conflicts like a Middle East war affecting oil. Now we present the clips of Marc Faber's insights from his recent interview with Kinesis Money. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
We will have especially a lot of volatility in precious metals because the dollar, in my view, is a doomed currency. Doom like doom. And the trend of the dollar's purchasing power will accelerate on the downside. In other words, cash money will lose value at an accelerating rate. Now, it may not happen so much against, say, currencies like the euro, or it may happen against Asian currencies, but especially against, say, cryptocurrencies or gold, silver, whereby if I look at the commodities complex, I find some commodities to be much cheaper than gold. Say wheat, corn, soybeans are very low. Copper is probably relatively cheap. Oil is very cheap compared to gold. So if World War III happens in the Middle East, I think you can assume that the oil price will not go down. And I have to say, my largest holding of all my assets is gold. That I have to say, and I will never sell it. Because when I look at central banks, it's a horror show. I mean, as anyone who trusts these liars and misleading characters and shady characters and people who've never worked in a private job, who could trust them? So I hold gold as an insurance policy. But I don't think that the gold price is all that cheap. When I compare my cost of living in 1950 and today, I have to say that the gold price is about where it should be. Well, I have approximately 25%. Then some gold bucks, they accuse me that I don't have enough gold. but You see, I don't think that gold is the best performing asset. It's probably the best store of value, you understand, over longer periods of
Indeed.
time. But what is the long term? Because you and I and everybody will die after a given time, sometimes sooner, sometimes later. So who knows? But I believe that in the stock market, you can make more money than in gold.
Mm-hmm.
But you have to be very careful, and you have to be very astute and follow stocks very carefully, and not buy SPAC stocks at the peak and meme stocks at the peak and unicorns at the peak and technology stocks in year 2000 before they dropped 70% and so forth and so on. So overall, if someone wants safety and sleep peacefully and go and have a pint of beer in a bar, then gold is quite a good tool to achieve that financial goal.
During the interview, Marc Faber discussed the Fed's response to expensive homes and affordability challenges. He predicts the Fed will continue printing money to tackle the significant debt. According to the New York Fed, aggregate household debt in the third quarter stood at $17.29 billion. Mortgages, credit cards, auto loans, student loans, and the like are only about half of the national debt, which hit a record $34 trillion on January 3rd. Furthermore, he recommended investors consider holding precious metals for safety and explore selected emerging market investments and gold shares. Let's get back to the interview.
I think the Fed is aware of the problem, but the Fed is in a different condition regarding residential properties. You understand? Residential properties. We had a colossal real estate bubble in 2007 based on subprime lending and so forth. But now property prices are much higher than they were at the peak in 2007 in most American cities, in Canada as well, and so forth and so on. And so the affordability has collapsed. At the present time, the lowest percentage of the population can afford to buy a new home. The affordability is extremely low. So my theory is that the Fed, they will continue to print money because there are two ways to go about the gigantic debt. There are three ways. Increase taxation. They're not going to do that in an election year. And two is default, and three is essentially by paying tax through inflation. Inflation is a tax on the system. It's a very unfair tax. It touches the poor people and the middle class much more than rich people. Rich people, like who have assets like myself, they benefit from inflation because our cost of living also goes up. But our assets go up more than the cost of living. The whole subject is very complex. And, everybody thinks, well, asset prices will collapse. This is not necessarily my view. Selected assets have already collapsed and others will in future. I would think that the FANG and FANG-related stocks, the Magnificent Seven, are very vulnerable. But at the same time, if you look around the world, there are European stocks and especially stocks in emerging markets that are very depressed. They're very inexpensive, especially relative to US stocks. Aside from holding precious metals for the safety aspect, also hold selected emerging markets and gold shares relative to the US market and relative to the price of gold are incredibly low. Have gold in bars and also in small coins, because when the hell will break loose, if you go to a department store, you can't pay with credit cards because they will switch off the internet and the electricity. So you need small denomination gold coins.
One way that central banks have sought to reduce their exposure to the U.S. financial system is by increasing their holdings of gold. Gold is a tangible asset that is not subject to U.S. sanctions and, therefore, offers a level of protection against the economic impact of sanctions. In the ever-evolving economic landscape, gold plays a crucial role as a safe haven asset. How do you perceive the current dynamics influencing gold prices? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.